Hi James, hi Steve. Thank you for joining me to review portfolios going into 2026. Steve, let's start with fixed income. How are we positioned?
Broadly speaking, we're positioned in both government bonds and investment-grade corporate bonds, with a side of high-yield bonds too. So we've got some nice diversity there. Our major positions have been government bonds at this moment in time, and investment grade. So we're taking a fairly limited amount of credit risk at this moment in time, largely because the extra risk premium that's on offer from the market for high-yield bonds is a little bit narrower than we would ideally like. But we're also, although we've got a sort of a bulky position in government bonds, we've also limited the amount of interest rate risk that we've got there too. So we think that the outlook for interest rates is one that supports ongoing reasonable amounts of income from fixed income positions, but it's not one that we really want to be too exposed to in terms of the potential for higher interest rates at the long end of the yield curve. We think that short-term interest rates are going to come down a wee bit more. The question then is that going to be automatically reflected in the long end? Probably, we think, but perhaps not. There are a few risks out there. If you take, for example, a poor fiscal position that the British government's in, the Japanese government, the US government. So in terms of government bonds, there is some pressure on the long end of the yield curve that we anticipate, and we're just limiting the amount of exposure that we've got to that particular risk. So we're pretty nicely blended in terms of our fixed income position at this moment in time.
That all makes sense. James, how are we positioned in equities?
I think just following on from Steve's last comment in terms of a blended approach, our equity component is just that. We're positioned for positive, albeit quite uneven, growth for this year. There's certainly geopolitical risk that we need to think about. So, a large component of our equity positioning is the world's largest economy, the US, and then more targeted allocations where that may be the UK or regions of Europe, and also emerging market equities. We like the UK, more favourable valuations, essentially what are these businesses trading at versus their global peers, but we're quite focused on larger, more globally diversified businesses in terms of their earning streams. So that gives us a degree of diversification away from the UK economic conditions in isolation.
Okay, that describes our regional exposure, but how are we allocated in terms of different company sizes and sectors?
For 2026, I think, on the committee, we agreed that there's a range of outcomes. So diversification is playing a key role within our equities component, like you mentioned, in terms of company sizes and at the industry level. In terms of company sizes, so, throughout 2025, it was the mega cap tech-related stocks that drove markets. In the latter part of the year, we saw the UK, European markets come to the table in terms of that broadening out of market returns. In terms of our exposure to different sizes of companies, so we're perhaps more diversified than we normally would be within the equities component. We're not overly concentrated in those large mega cap stocks that drove performance last year. There's a degree of cyclicality throughout the portfolios through those more medium and small sized businesses. And then on the industry side of things, we do have exposure to the tech sector through AI innovation, but we've also got quite explicit defensive plays. So that could be through consumer staple stocks, utilities, and also healthcare businesses. So those elements really help shore up the portfolios against equity market volatility. So in summary, across our equity components, we're positioned for continued growth in 2026. We're well diversified for an array of possible outcomes throughout the year. We're also mindful that there's a broad array of possible outcomes for this year, but we're comfortable that we're not overly exposed to any one of those potential outcomes.
Okay, thanks James, thanks Steve, and thank you to our investors for your continued support.